Ajay Bagga is now joining us on a phone line. Ajay, good afternoon. Thank you so much for taking our call. First, a view on the Indian market. Last 8 days, or in the last 8 days, we are down 7 days. Do you think it's slightly overdone?
Pankaj, looks like it's quite overdone. We've reached 13-year lows today, and clearly the fundamentals are not deteriorated that much, nor were we so overvalued to justify going back 13 months in history in terms of the market levels. So quite overdone, but technically very key support levels were broken, Pankaj. So very difficult right now to give a buy call. At least in the short term, might be better to wait out December 16th and then look at your short-term trades. Longer term, good time to allocate money to the market as any. And in fact, you're getting a 13-month discount, so it's a better time to come in.
Right. Ajay, yesterday we had 2 IPOs and we got fantastic response. Retail, HNI, QIP, all of this over there. Considering markets the way we are in the last 7-8 days, you think the IPO market, has hit a new high? So why that particular opposite sentiments coming in?
Yeah, that's what, and that's where you are talking of packaging because, you launch something, the same detergent saying it has got more oxygen and it's better. And I think that's what's happening. So 75,000 crores got bid for the 2 IPOs with huge oversubscription, 44 times and 33 times. Clearly, there is money in the market. Clearly, there is appetite for Indian equity. And you have existing companies with multiple year cash flows going begging and getting sold into. I think it's a very bipolar market in that sense.
Right. Do you see this as a buying opportunity over a period of 12 months? Because we are exactly opposite of what we were in 2014. Markets at a high, expectations very high. People were estimating a lot to come in from the new government. But now it's exactly the opposite when we are at the end of 2015.
Absolutely. I think very well put. It's a mirror image, actually. You've gone back 13 months and instead of expectation, there's pessimism. And everybody's banking stocks have got hammered because of what a newswire put out about the RBI governor saying we don't know the context, we don't know exactly what he meant. Definitely, he wouldn't have meant to bring down the bank Nifty by 2.5%. So let's see what has he said and why this kind of reaction. Also, Pankaj, it's a well-known fact, the stressed assets in the banking system. So that's why you are giving the price to book what is being given by the market to the PSU banks. There is no deterioration on that end. If anything, rates have come down 1.25% and slowly those rates are percolating in the lending rates as well. So clearly this is a market going on sentiment, a lot of pessimism. So yes, on a 12-month basis, it's a buy market definitely. It is a market lacking domestic catalyst. And with the global scenario being a little muddled, we are seeing the market suffering. But in terms of money, there's enough and more money, which is what the IPO market is showing you. The tax-free bond market, if you look at, every issue is getting subscribed within minutes. So there's huge appetite of savers in this country. With the right packaging, right product, we are seeing enough investors coming in. Ongoing basis, this market is not attracting that kind of money. That's a worrisome point. Second, the government has not really managed to showcase a lot of optimism for investors vis-a-vis the economy. I think that is what's causing a lot of the pessimism because even we are really searching for some catalyst. The next question could be, what is the catalyst for this market to go up? And there's no answer with conviction that comes in.
Right. Do you think that, looking at the commodity prices, where some of the commodities like iron ore, crude has fallen, people have clearly given up on global growth and, this could be, classical bottom formation. Maybe it may fall another, global equities may fall another 10-20%. But do you think that we are closer to the bottom?
Definitely, I think Indian equities-wise, we are pretty close to the bottom because these kind of valuations you normally, don't get in India. So it is a good time-wise correction. You're getting 13-month-old rates in the market. Globally, I think a lot of the December 16th event is already discounted in. I've been talking about the previous 6 interest hikes in the U.S. 5 out of 6, the markets were up 1 year down the line. Gold was up, dollar was low. So it becomes a mirror image to some extent. Going into the rate hike expectation, markets take one view, and as the event happens, the market reverts more to the mean. So overall expectation is markets are pretty near the bottom, and we should get better markets next year, especially India with its growth story, with the cyclical upturn that's very much coming through. Sentiments are bad, expectations are very low. That makes for a good investment horizon. But again, I'm saying short term, you might be whipsawed quite badly. So short term, this is not the time really to get into the markets because it's just too volatile. Whatever you have to do, take a medium-term view and then move ahead. One-year basis, markets are looking quite attractive.
Right. Ajay, just a last word. Going into 2016, as you just told us that economy is on an upturn, the best way to play this markets would be the domestic cyclicals or, sticking to the domestic linked names?
Yeah, definitely. I think banks, after today's correction, banks are a screaming buy. You're getting a good entry point into the banking sector. So private sector banks, NBFCs, very much. Auto, despite the news flow, I think autos are on a good roll on the urban consumption theme. FMCG, IT. I think these would be clearly the big picks, out of which 3 are domestic consumption. IT is the one which is more linked to the global. Plus, it's playing on the depreciating rupee. So, without the issues that pharma is facing, IT still you are seeing clarity of 10 to 12% growth baked in. And if some of them get their models ratcheted up more into the digital space, you could see even further. So, quite a few good stories. Cement would be another one, which I've been emphasizing for some time. I think cement, a lot of operating leverage, and new capacity additions will not come in a rush now at 60% capacity utilization. So a lot going for that sector that can turn around quite fast. In the next 6 months, you could get good returns from cement as well.
Right. Ajay, thank you so much for taking out time for us. Always a pleasure talking to you.